Okay, so Boyd Group didn't just report earnings today. They basically parked a massive $1.2 billion pile of cash on the balance sheet purely so they could swallow their rival Joe Hudson's whole. It is March 18th, 2026, and we are looking at the Q4-25 results for Boyd, ticker BGSI. So, Miro, we have a fairly standard collision repair network acting like an aggressive Wall Street acquirer. What kind of quarter was this, actually?
Well, it is... Sorry. It's a quarter with a split personality. You look at the top line, and revenue is flat sequentially at $793.9 million. But the operating engine is actually humming. Gross margins stayed totally flat at 46.3%, and adjusted EBITDA reached $103.6 million. So they are pushing a very healthy 13.1% margin there.
Right, except I am looking at the bottom line here, and net earnings completely fell off a cliff.
Yeah, they dropped over 55% to just $4.8 million. The culprit is almost $10 million in one-off M&A integration costs, just eating them alive. Diluted earnings per share plunged down to 19 cents, though if you let management adjust it, and they love to adjust it, adjusted EPS actually rose to 90 cents.
Absolute magic of non-GAAP accounting, which is probably a good time to remind everyone that we are just two friends talking markets, definitely not giving financial advice, so please do not go trading your actual car for stocks based on our personal opinions. But honestly, the market didn't buy that adjusted fairy tale today at all, did it?
Not even slightly. The stock was choppy, but mostly flat for the actual quarter, but today the tape was just ugly. It opened around 160, and then the sell-off accelerated straight through the morning call. The stock hit an intraday low around 135 and finally closed down 12.39% at 140.27. Dead flat in after hours, too.
Jeez, that is a brutal reaction for a company that fixes fenders. And I think part of that frustration is this bizarre operational hiccup they admitted to in Q4. So they recently stopped paying out unused vacation time as cash. Because of that HR change, every technician in their network basically walked off the shop floor in December to use their days before losing them.
It is incredible. You have this massive corporate cost-cutting push, finding $30 million in savings, and then a back-office holiday policy inadvertently chokes off their own repair capacity. It completely bottlenecked vehicle turnaround times. And it shows up in their same-store sales, which slightly slowed to 2.2%.
It really is the ultimate reminder that you can optimize the spreadsheet all you want, but you still need actual humans holding the wrenches to make money.
Exactly. The theory always crashes into the physical reality. And it gets even more interesting when you look at how they're actually generating profit on the repairs they do finish. The unit economics are shifting under the hood.
All right, let's get into the details on that.
Right. Think about what happens when you actually bump a fender today. It is not just sheet metal anymore. It is radar, cameras, LiDAR. Modern cars are essentially rolling computers. And historically, body shops just outsourced all that software calibration to third parties. They would literally just hand over a 25 or 30% markup to an outside tech vendor.
Which is terrible for your margins if those sensor repairs keep growing as a percentage of the total fix.
Exactly, but Boyd has actively shifted this. They hit a 75% internalization rate for their U.S. scanning and calibration this quarter. That is up from 53% last year. They are basically taking that entire markup back in-house. That is a massive structural margin engine.
That makes so much sense. So instead of just eating the cost of increasingly complicated repairs, they are basically acting as their own specialized tech vendor. That completely explains how they maintained a flat gross margin and actually expanded that EBITDA margin despite the holiday volume drop we just talked about.
Yeah. It is a core piece of what they call Project 360. They're aiming for over $100 million in structural savings. And the CIO, Brian Kaner, basically spelled out the confidence here. On the call, he said, and I'm quoting, "We expect the pathway to 14% in the base business to be paved by Project 360. No doubt that Joe Hudson's profit profile enhances and accelerates our ability."
So they buy a massive rival to essentially just clone the synergy across 258 more shops?
Right, but this is where I start looking a little closer at the math, because the underlying operations are strong, but the way they're framing the profit is getting highly managed.
You're talking about the gap between that amazing EBITDA and the actual $4 million in net income?
Yes, and specifically how they are treating adjusted net earnings. This is classic aggressive accounting. Starting this Q4, Boyd abruptly decided to exclude the amortization of intangibles tied to past acquisitions from their adjusted metric.
Wait, back up. They just stopped counting the trailing cost of buying other companies?
The intangible part of it, yes, which magically fluffs up their non-GAAP earnings per share going forward. Now, they did restate historicals, so the spreadsheet comparison looks apples to apples, but think about the timing. You are about to close on Joe Hudson. You are swallowing a huge chain. By changing the rule right now, you neatly sweep a huge chunk of invisible acquisition drag out of the headline metric.
That is so convenient. They are changing the scorecard right before they step up to the hardest hole in the course.
That is a very polite way to say they are engineering the optics. And speaking of the balance sheet, the other thing to watch is their lease liabilities. They are skyrocketing. Almost $780 million sitting there right now.
Jeez, is that just from the sheer volume of shops they are acquiring?
Not just acquisitions. It is a total shift in how they do startups. In early 2025, they moved to a model where they outsource the physical construction of a brand new shop, instantly transfer ownership to a leasing company, and then Boyd just leases it back.
Okay, so it looks like brilliant capital discipline today because they avoid massive upfront property costs.
Right, except you push all of that heavy expansion strictly onto the lease liability line. And with over 30 new greenfield and brownfield locations in the pipeline right now, that leverage is going to swell fast. It works beautifully as long as the cash flow from repairs stays absolutely bulletproof.
So as long as people keep getting into accidents and insurance keeps paying premium rates, the machine just hums along. But if pricing power slips, those lease payments do not care about the macro environment.
No, they do not. It is an incredibly precise operational engine running very close to the red line.
So where does this leave them heading into next quarter, with this massive Joe Hudson integration actually hitting the daily reality of the business?
Well, it means they are running a marathon at a sprinter's pace. They are converting about 30 Joe Hudson stores to their IT framework every single week right now. That is a staggering integration velocity for a physical business. And their guidance shows they plan to just keep grinding out 8 to 10 brand new locations every quarter on top of that.
30 a week? That just sounds like an IT department's literal nightmare. But if they pull it off, I guess they unlock those, 35 to 45 million in supply chain synergies they promised?
Exactly. Half of that is supposed to hit in 2026, and they are getting some structural cover from the market to execute this. Kaner actually pointed out on the call that the industry backdrop is less competitive right now. He thinks it is putting them into position to be, his words, the acquirer of choice.
The acquirer of choice. That is a very CEO way of saying we are the only ones left with a massive checkbook. Though they do have some weird localized headwinds right out of the gate for Q1, right? Because they had that bizarre string of winter storms in January.
Yeah, a deep freeze swept from Texas over to the Carolinas and literally shuttered their southern shops for days. Incoming recs just paused. When you combine that dead air with typical heavy U.S. first quarter payroll taxes, their early 2026 margins are going to take a noticeable hit. But the thing is, once the ice melts, the recs resume. The demand does not disappear. It just gets deferred.
Right. The physical reality strikes again. So if I'm looking at the big picture here, Boyd is basically building the ultimate scale engine. They have figured out how to squeeze software margins out of crushed bumpers. They have the cash war chest, and now they just have to prove they can swallow a giant rival without choking on the transition.
Pretty much. They are betting this entire next year purely on elite execution. It's impressive, assuming they actually look up from the financial modeling in time to fix the cars.
Well, let's just hope their integration team actually gets to take their vacation days this year. All right, I think my brain is officially full for the day. If you want these earnings breakdowns to just quietly show up in your feed, go ahead and follow the podcast. Just a quick note that this show is an AI-generated experiment, which is honestly how we managed to compress hundreds of pages of dense filings into a short chat. You can send any ticker requests over to earningsunscripted@datamadness.ca or find the X link in the show notes. Thanks for hanging out, and we will catch you after the next bell.
See you out there.